Okay, so picture this, two investors, same starting point, both diligently saving.
Hmm.
One goes for mutual funds, the other ETFs. 20 years later, one is a whopping 10,000 richer.
Oh, wow.
The secret. Not market genius, but something sneakier, hidden fees. Welcome to Smart Money Discussions, where we decode finance so you can make savvy decisions.
It's a classic trap, and so many people think ETFs are just automatically better.
Yeah.
But there's a whole lot more to this story.
More to the story.
Yeah.
That has me intrigued.
Yeah.
Today, we're breaking down ETFs versus mutual funds so you keep more of your hard-earned cash.
Right.
And trust me, there are some shocking industry secrets you'll want to hear.
Oh.
But first, let's back up a bit.
Okay.
Help me out here.
Sure.
What are ETFs and mutual funds in the first place?
Let's demystify these terms. People hear ETFs, mutual funds, and kind of just nod along.
Yeah, I'm
But-
guilty of that too.
So both of them let you pool money with others to buy lots of assets.
Okay, so think of them as baskets full of stocks, bonds, whatever the fund focuses on.
Yeah.
Yep, exactly. Like a diversified portfolio, all in one package.
But buying and selling them, that's where things get interesting, right?
That's where the key differences come in.
Yeah.
ETFs, they trade like stocks. You can buy and sell them throughout the day at the market price.
So just like any stock I own.
Exactly.
Yeah.
Whereas mutual funds are priced once at the end of the trading day.
So with an ETF, I can react to market changes instantly. But with a mutual fund, I'm stuck with whatever the closing price is.
Exactly. You got it.
Interesting.
And that actually links to another big difference, the management style.
Okay.
Most ETFs passively track an index like the S&P 500.
So they're just trying to match the market, not beat it.
Exactly. They're not trying to pick winners or losers, just ride the market wave.
Yeah.
But mutual funds, they can be passive or actively managed.
Actively managed, meaning there's like a hot shot manager trying to pick the best stocks.
Yep, that's the idea. They're
Wow.
trying to outperform the market.
Sounds risky.
It can be. Some active managers are skilled, but it comes at a cost. Cost. That brings us back to that $10,000 difference we talked about.
You got it. That's where the fees come in.
Okay, now before we dive into that, if you're finding this ETF versus mutual fund breakdown helpful, hit that subscribe button.
Yes, please do.
New episodes every week packed with financial advice.
Absolutely.
Now back to these fees. You're talking about expense ratios, right?
Precisely.
Okay, remind me again what those are.
So it's basically the percentage of your investment that covers running the fund.
Oh,
Paying the manager's admin stuff, the whole shebang.
So even tiny differences in these percentages can really add up over time.
You got it. Time is the secret ingredient here. Compounding can work for you or against you, depending on these fees.
Okay, all right, so give me the numbers.
All right, so the average expense ratio for an equity ETF is around 0.15%.
Okay.
For a bond ETF, it's even lower, 0.11%.
Okay, not too bad. But spill the beans, what about mutual funds?
Hold on, tight. The average for an equity mutual fund is a hefty 0.42%. Bond funds are at 0.37%.
Wow, that's like 3 times higher than ETFs. No wonder there's a potential $10,000 difference.
It's a big deal. Let's do some quick math to illustrate it.
Okay, I love a good math problem.
So imagine you invest $10,000,
Right.
earn a decent 7% return annually over 20 years. With a 0.15% expense ratio, like a typical ETF, you'd end up with about $39,000.
Not bad at all.
But with a 0.42% expense ratio, like many mutual funds, you're left with just $29,000.
Wait, that's a $10,000 difference.
Exactly, $10,000 gone just from fees.
That's a serious chunk of change disappearing. And some people probably paying even more than that, 0.42%.
Unfortunately, yes. It can get even worse. And here's the kicker. We're just scratching the surface.
Wait, there's more. I thought expense ratios were the main culprit.
Expense ratios are just the tip of the iceberg.
Oh, no.
There are hidden costs lurking in mutual funds, things like sales loads and trading costs.
Hidden fees. Come on, that doesn't seem very transparent or fair.
It's a huge problem in the industry, and these hidden fees can really eat into your returns.
Okay, give me an example.
Some mutual funds, for example, charge a sales load when you buy or sell shares.
Oh, yeah, I've heard of those.
It can be as high as 5% or more.
5%. Are you kidding me? What are they even for?
I know, it's outrageous. And the worst part is these sales loads don't even go towards managing your money.
So where does it go?
Straight into the pockets of brokers and salespeople.
It's insane. I'm starting to see why you're so passionate about exposing these industry secrets.
It's crucial information that's often hidden in the fine print, but we're here to shine a light on it.
This is eye-opening stuff.
Yeah.
If you're enjoying this deep dive into the hidden world of fees, don't forget to subscribe to Smart Money Discussions on YouTube.
Yes, subscribe.
We're constantly releasing new videos to help you navigate the world of finance. But we're not done yet, are we?
Oh no, there's more to come.
All right, so we've uncovered some pretty shocking truths about fees, but now let's talk about performance.
Okay.
Everyone wants to know,
Yeah.
which one makes me more money, ETFs or mutual funds?
That's the million-dollar question, right? But it's not so straightforward.
Come on, don't leave me hanging.
Yeah.
I was hoping for some clear-cut answers.
We'll get there, I promise.
Okay.
But it's important to understand the nuances.
Yeah.
Both ETFs and mutual funds have shown kind of a mixed bag in terms of historical performance.
Hmm?
Some have done phenomenally well. Others have well flopped.
So past performance is not a guarantee of future returns. That's not exactly breaking news.
Exactly. But we can look at some of the structural differences that affect how much of those returns you actually get to keep.
Okay, I like the sound of that.
And that's where ETFs often have a significant advantage, tax efficiency.
Yeah, tax is everyone's favorite topic. But seriously, how can one be more tax efficient than the other?
Right.
They're both just baskets of investments, right?
Right, but it's the way those baskets are structured that makes all the difference.
Okay.
ETFs, because they trade on exchanges, have this unique creation and redemption process
Uh,
that minimizes the need to sell underlying assets within the fund.
okay.
This means fewer capital gains distributions.
Capital gains distributions. You're going to have to break that down for me.
Okay, so imagine a fund sells some of its holdings at a profit.
Yeah.
That profit gets distributed to shareholders as capital gains.
Okay.
And guess what? You have to pay taxes on those distributions,
Even if I haven't sold any of my shares.
even if you haven't sold any of your own shares.
That's right.
Wait, so even if my mutual fund is doing well, I could still end up going taxes just for holding on to it?
That's the crazy part. It's a hidden tax burden.
Wow.
ETFs, on the other hand, tend to be much more tax efficient.
Okay.
You only pay taxes when you actually sell your shares and realize a gain.
So less tax means more money in my pocket.
Exactly.
Okay. I'm starting to see the appeal of ETFs. But are there ever situations where mutual funds might make more sense?
Absolutely. Remember,
Yeah.
there's no one-size-fits-all answer in the investing world.
Right.
It's all about finding the right fit for your individual needs and goals.
So how do I figure out what's best for me? Should I just flip a coin?
Let's not leave it to chance.
Okay. Consider this. Even Vanguard, a company known for its low-cost index funds, offers both ETFs and mutual funds.
Interesting. So they recognize that different investors have different preferences.
Exactly. So let's walk through some situations where one might be better than the other.
Okay, perfect.
Well, if you're a long-term hands-off investor, the kind who sets it and forgets it, a mutual fund could be a good option.
Okay.
Especially if you're using an automatic investment plan where you regularly contribute a fixed amount.
That makes sense. Just consistently adding to my investments without having to constantly monitor the market.
Exactly. But let's say you're more of an active trader, someone who enjoys having more control over their investments
Okay.
and potentially capitalizing on short-term market movements.
You mean someone who likes to buy low, sell high?
Precisely. In that case, the flexibility and potential tax advantages of ETFs might be more attractive.
So it really depends on my personal investing style and goals. There's no magic bullet here.
Exactly. But before you rush off to make any decisions, we should probably hear what some of the biggest names in investing have to say about all this.
Ooh, this is the part I've been waiting for. Spill the tea on what the investing legends think.
Okay, let's start with John Bogle, the founder of Vanguard and the pioneer of index investing.
Okay, the OG of index funds.
You'd think he'd be all about ETFs, right?
Yeah, I would assume so.
Well, it's not that simple.
Ooh, a plot twist. I'm intrigued.
He initially had some reservations about ETFs.
Really? What was he worried about?
He was worried they'd encourage the kind of speculative trading that he was so against.
That makes sense. Given that ETFs are traded all day long, it's easy to see how they could tempt people to try and time the market.
Exactly. And Bogle was all about long-term buy and hold investing.
Right, the opposite of market timing.
Exactly. He even famously called ETFs passive funds owned by active investors, highlighting that kind of contradiction.
That's a pretty insightful observation.
It is. But here's the thing. Bogle's views on ETFs did evolve over time. He eventually came to accept that broad market ETFs, like those tracking the S&P 500, could be suitable for long-term investors.
As long as they weren't constantly buying and selling, trying to outsmart the market.
Exactly. His main message remained, resist the urge to overtrade, stick to your plan, and let time do its thing.
Sound like solid advice.
It is.
Yeah.
And by the way, that aligns perfectly with his preference for traditional index funds.
So Bogle gave a cautious thumbs up to ETFs, but only for certain types of investors. What about Warren Buffett? What does the Oracle of Omaha have to say about all this?
Well, Buffett has been a very staunch advocate for index funds over actively managed funds.
Interesting.
He's even gone so far as to say that the best investment for most people is a simple, unmanaged index fund.
Coming from him, that's a pretty strong statement. Why is he so against active management?
A few reasons. First, he believes that consistently beating the market is incredibly difficult, even for the pros.
And there's plenty of research to back that up. Most active managers don't outperform the market over the long run.
Right. Second, he hates the high fees associated with actively managed funds. He's all about keeping costs low,
Yeah.
and he sees index funds as the most efficient way to do that.
Lower fees means more money for the investor. That's definitely in line with his philosophy.
Absolutely. And remember that famous bet he made against a group of hedge fund managers?
Oh, yeah, the $1 million bet.
He wagered $1 million that an S&P 500 index fund would outperform a portfolio of hedge funds over 10 years.
And he won, right?
He won by a landslide.
Wow, that's got to hurt for those hedge fund guys.
Mm.
But it really proves Buffett's point, simplicity and low costs often win the race.
Exactly.
This has been incredibly insightful. But I have to admit, I'm feeling a bit overwhelmed. How am I supposed to make a decision between ETFs and mutual funds?
Don't worry, we're going to break it all down into a clear framework you can use to make the right choice for your situation.
A framework that's exactly what I need.
Oh.
But before we get to that, make sure you're subscribed to Smart Money Discussions so you don't miss any future episodes.
Yes, hit that subscribe button.
We've got tons more valuable financial insights coming your way. Okay, so we've covered a ton of ground fees, performance taxes, even what the investing legends think.
It's a lot to take in.
It is.
Huh.
Help me put it all together. How do I actually choose between an ETF and a mutual fund?
All right, let's create a roadmap for you.
A roadmap, I like it.
Because remember, the right choice is personal. What works for one investor might not work for another.
Right.
So we've talked about the costs, the tax impact, different investing styles, and your personal goals.
Right.
Let's frame our decision around a few key questions.
They hit me with the questions.
First, ask yourself, how involved do I want to be with my investments?
Okay.
If you enjoy researching companies, picking individual stocks, and actively trading, the flexibility of ETFs could be a good fit.
Makes sense.
Oh.
If I'm buying and selling frequently, being able to trade ETFs throughout the day is a big advantage.
Exactly. Second question, how important are taxes to me?
Okay.
If you're investing in a taxable account, minimizing those pesky capital gains distributions can make a big difference in your net returns.
Yeah, after learning about those taxes on gains, I haven't even realized yet. I'm definitely prioritizing tax efficiency.
Smart move. ETFs generally win out in that category.
Good to know.
Now, third question, what are my investment goals and how long am I investing for?
Okay.
If you're saving for retirement decades down the line and you prefer a hands-off approach, a mutual fund with an automatic investment plan could be a good option.
The classic set it and forget it strategy.
Exactly, just steadily contributing to your nest egg without having to constantly make decisions.
Makes sense.
But if you're saving for a shorter-term goal, like a down payment on a house or a dream vacation, and you're comfortable with potentially more volatility, ETFs might be worth considering.
So my time horizon plays a crucial role in this decision.
Absolutely. What's the final question on our roadmap?
Lay it on me.
Remember what both Bogle and Buffett emphasized? Do I prioritize simplicity and low costs?
Right.
If that resonates with you, sticking with broad market index funds, whether ETFs or mutual funds, could be the way to go.
Low-cost simplicity, long-term thinking. That seems like a solid philosophy for investing and for life in general.
Absolutely. Couldn't agree more.
Well, I feel so much more confident now. Like, I can actually have an informed conversation about this topic without feeling totally lost.
That's what we like to hear.
And for all our listeners out there, make sure to subscribe to Smart Money Discussions for more deep dives into personal finance. We're here to help you make smart money moves.
Hit that subscribe button, stay tuned for more valuable insights, and don't forget to leave your questions and thoughts in the comments. We love hearing from you.
Until next time, keep learning, keep growing, and remember, the smartest investment you can make is in your own financial education.